Good day, friends. I would like to dedicate this video to an extremely important topic of trading, especially when trading futures options. It's about margin call. This is the urgent request to add funds to meet margin requirements. Let's work with a concrete example to avoid empty talk. Let's imagine we have a position at current levels of volatility. For example, a strangle is a very popular choice. Let's say we sold call options 100 contracts and put options 100 contracts. As a result, we have a strangle. Here we expect that the price will not go beyond the break-even point. To recap, I sold put options strike 25,500 and we ended up with the break-even point of 26,500 and 27 is another break-even point. Once you have built the strategy or made changes to your chart, be sure to click the GM button and the margin requirements will be recalculated. In this case, we end up with $427 in margin requirements. Let's assume that we don't use delta hedging, we don't limit our risk, like unfortunately many other traders who lose money because of this. Let's say a Bitcoin move happened. The price went above 27 and ended up in this zone. Or the price went down a lot, ended up in the zone below 25. What happened to our delta? You can look right here. When you hover your mouse, you can see what the delta, gamma, theta, and vega and PNL values will be. With the price of about 27, our delta will be minus 52. After that, our margin requirements will increase a lot. Let's try to calculate it now. 27,000. Oh yeah, we choose current volatility levels. The margin requirements are being calculated as it is right now. But I'll tell you for sure, the margin requirements will go up. And you're gonna have a negative P&L because of the price movement. And it is possible that you will have insufficient funds in your account to cover the margin requirements. Imagine you don't have $425 in your account, but only 400. In this case, you will receive a margin call, a letter requesting you to add funds to cover the risks. Different exchanges do business differently. On regular exchanges, they will simply liquidate your position. Instead of $400, you will have zero, and your position will be liquidated. Sometimes you don't even get a margin call from them. On the AE.exchange, there is no such liquidation. You get a letter in which you will be informed about insufficient funds, and you add the funds quickly in a couple hours. Or you close out a part of the position yourself. You buy back the call options you sold, some of them. That way, you reduce your margin requirements. You go below 400, now it's 395, and you won't be bothered by a forced close again. If you haven't done any of the above, after 2 hours, the risk manager will close some of your positions. He will buy back some of the call options you have sold to reduce your margin requirements to the required level. The margin call is not something to be afraid of. It is your assistant, a signal to act so that you don't lose money. It is just a warning that you are exceeding the risk and thus violating the margin requirements. Naturally, you have to react to a margin call. You need to deposit money or reduce your risk by closing the part of your position. There is nothing complicated about it. The AE.exchange risk module allows you to close a part of your position, buy back your options, and place orders that will lower your margin requirements. If something doesn't work, something you can't understand or do, you can always contact AE.exchange support. Write to the email client or reply to the margin call mail and ask what actions you can take to reduce your risk. I recommend taking the margin call message seriously because it can save you from losing significant funds. By responding correctly to a margin call, you will reduce your risks. One more point, if you do nothing, do not deposit funds, do not reduce your position yourself, and your margin requirements still exceeding the amount of funds in your trading account, then a higher commission will be used to force closing of some of your positions. Keep that in mind. So, friends, I think this is a useful video about margin requirements. I want to believe that after this you will stop being afraid of margin calls and will react to them correctly. It will help you to save your money on the stock exchange and multiply it. Everyone gets a margin call in one way or another. The most important thing is not to ignore it. If you liked this video, leave a like, ask questions in the comments, I will be glad to answer them all. Subscribe to the channel if you haven't already. I wish you all the best and successful options trading.